Hello, Alexander here, Intermediate Accounting, Chapter 2, Review of the Accounting Cycle. The accounting process starts off with two interconnected parts, the recording phase and the reporting phase. And these two phases are both very important. The recording phase is always happening, so it's just always recording transactions as the business goes along, while the reporting phase happens whenever the company needs to report, maybe once a year, monthly, quarterly. That's up to the company. But the reporting phase basically takes these transactions, puts it into financial statements, income statement, owner's equity, cash flows, balance sheet, what have you, and reports them. But the reporting process never stops. So even as you're reporting the past performance of the company, you're still recording new transactions going on. And so the recording phase has three parts. Business documents are analyzed, which is basically receipts, invoices, things that come across that show that a transaction happened. And then transactions are recorded. This is where you take the receipt or the invoice or whatever transaction it was and record it as a journal entry. Next, transactions are posted. This is where you put it to the right account, the right ledger for it. So it goes from being a receipt. So you go to the store, you purchase a gallon of milk for $3. Your milk expense went up, your cash went down, or grocery expense went up. So then you take that receipt, and of course you do the journal entry, debit milk expense, or grocery expense, what have you, credit the cash for the amount, and then you post it to the appropriate ledgers. So the milk expense, grocery expense goes to the grocery account, tracks all the other purchases in that category, and the cash goes to the cash account, dropping it, or your bank account lowers it. And that's pretty much, that's just same with the company, just bigger scale. And then the reporting phase, first off, a trial balance of the accounts in the general ledger is prepared. This I left out, I think, most likely in the beginning videos in financial accounting 201, 202. This is a check and balance system. This is very important to do, though. It's just where you take all your debits, all your credits, line them up in a column side by side, so that you count them and you make sure that at the bottom, this debits equals this credits. That's all it is doing this. It's just making sure there's no errors. It's to catch an error. And trust me, I've seen students, they've messed up on that before. It's very easy. And so if you have a trial balance, you can catch it before you keep going, and then you don't know where the error may have happened. If you do a trial balance before you do adjusting and before you do closing, it just makes it simpler. That way you know if there's an error in the trial balance, it wasn't in the adjusting or the closing, it was just in a normal journal entry. Okay, then the adjusting entries are recorded. Now, adjusting entries are what we talked about before. Let's say it is unrecorded assets, which means if someone owes you interest, you debit interest, credit interest receivable, and there you go. You don't own, at the end of the month, you don't have the interest cash yet, but you've earned it because it's been enough time. Same thing with unreported liabilities. The vice versa. You owe interest at the end of the month, your interest expense goes up, debited, and your interest payable gets credited. You see? Oh wait, when you're owed interest, it's you debit interest receivable, credit interest revenue. So you've earned the interest, you just haven't turned it into cash. Whereas the opposite with interest expense, you owe interest, you just haven't paid it. And then of course, you have unearned revenue, which means someone paid you maybe a year in advance. If someone pays you a year's worth of rent, at the beginning of the year, every month you need to, it originally started as unearned revenue, credited, debited is the cash they gave you. So after a month, you take 1/12 of that, you debit unearned revenue, and you credit rent revenue. So now you're moving it from unearned to earned, because you can now officially claim it as revenue. See how very, very important. And then prepaid assets. Prepaid assets at the end of the month, you prepay for maybe insurance, so you pay a year's worth of insurance ahead of time. At the end of the month, that prepaid insurance, which is an asset, 1/12 of that gets expensed. So now it's insurance expense you debit, and you credit prepaid insurance for 1/12 of the cost. So let's say they prepaid you $12,000. That means $1,000 would now be expensed. And then financial statements are prepared. So financial statements come after adjusting. This is just the reason for that is after you've adjusted everything, it's all brought up, it's all up to date. Now you can make your statements. After the statements are prepared, nominal accounts are closed. So now you're closing accounts, which means you're going to zero them out to start fresh for next month. And then you're going to do a post-closing trial balance. For closing accounts, it's just the same thing. All your temporaries are going to be zeroed out to the retained earnings. So now we're not using income summary anymore. Income summary was something you used in the beginning accounting, 201, 202. In intermediate and in the real world of accounting, you just close it all out to retained earnings. There's no income, there's no like intermediate account. That's just to train beginners to kind of get the feel of it, to see where is it going and how it works. But otherwise, you just close it out to retained earnings. Okay, and then post-closing trial balance, once again, is your post-closing trial balance. It's where you just make sure everything's up to date. Nothing out of the ordinary. And so financial accounting uses double entry accounting. Big surprise, huh? Assets equals liabilities plus owner's equity. This hasn't changed. This is almost like a review chapter 2. It's like the first chapter. It's probably stuff you already know, but that's all this chapter was review. But it's important to hit this so that you can never, I always believed you can never review enough. The basics, you need to have solid foundation in. It's pivotal to have that concrete. And so, and I may end up putting a little bit of an annotation to show you the equation assets equals liabilities and owner's equity, so I can like present it here and have it pop up, and it'll be kind of neat. Every journal entry involves a 3-step process. Identify the accounts involved with an event or transaction. So make sure that when you're about to do a journal entry, find out what 2 transactions, or if there's more than that, what accounts are going to be in the mix. Next, determine whether each account is increased or decreased. So now determine, is it on the left or right? Is it going up? Is it going down? Depending on what it needs to be. And then 3, determine the amount by which each account was affected. So now you're going to find out the amount, the number. So the number comes last. It's more important that you get the right account and you get the right, is it being debited or credited, and how is it going up or down? Does it need to go up or down? All right, so assets are increased by debits and decreased by credits. Assets go up with the debit, down with the credit. Remember, debits are on the left, credits are on the right on the paper when you're looking at it. Liability and owner's equity accounts are increased by credits and decreased by debits. So debt, liabilities, goes up by a credit, goes down by a debit. Owner's equity for a corporation includes capital stock accounts and retained earnings accounts. So we're going to be dealing with a lot with the stock, because corporations are pretty much what we're going to stick to. That's what you're going to run into a lot. So corporations use capital stock, which is stocks, and what you see on the stock market, and retained earnings account, which is basically owner's equity. And capital stock too is like owner's equity. It's all equity. Now, the difference between the stock market and, of course, stock for accounting is the stock market. People vote by buying it, and that's why the price goes up and down. The price of a stock market, though, does not reflect what the price of the stock is book-wise. So remember that. The books are usually completely different. They're usually a lot more conservative. They don't tend to go up and down with the stock market. They usually stay what they've historically been, what they sold for. And then the stock market is just to show what they're trading for, what someone's willing to give you for a stock. So two different things. So you're going to learn that a lot in how stocks are done accounting wise. And anything over the par value of a stock goes into paid-in capital, which we've done on chapter and then before chapter. Okay, so revenues, expenses, dividends relate to owner's equity through the retained earnings account. So revenues are a part of equity. Expenses and dividends are increased by debits and decreased by credits because they reduce owner's equity. So expenses go up with the debit, and dividends go up with the debit because owner's equity goes up with a credit. So a debit reduces it. Expenses are going to reduce your equity. It's you're losing. It means you're reducing your equity because it's like money you're losing. Revenues are increased by credits and decreased by debits. That means because revenues are increased by credits, they're going to increase owner's equity because owner's equities are increased by credits. So they're synonymous. The difference between total revenues and total expenses for a period is net income or loss, which increases or decreases owner's equity through the retained earnings account. So if you have a net income, which means you have more revenue than expenses, your retained earnings goes up. If your expenses are more than your equity, retained earnings goes down. And so that's chapter 2 in a nutshell. It was nothing new, what you've done before, but it's a review chapter because this is I'm going to be going over 22 chapters, split into two between 231 and 232. This is two classes within this book, 11 chapters each. So it's good you tuned in for this one just to get a refresher. And of course I'm going to do something on the board. I'll do maybe 4 practice exercises, but thank you for tuning in. Please like, subscribe, comment, ask questions, whatever you feel like, whatever lets me know you enjoy it, and I'll see you next time, and thank you so much.